I'm going to be showing you how you can calculate your true cost of home ownership. This video is going to be extremely helpful if you're thinking about buying a home and you're trying to figure out if it would be cheaper to buy or rent. And it will also be helpful for homeowners who are just simply trying to do some financial planning. So in this video, we're going to go through a hypothetical example where a buyer purchases a home for $1 million with a 20% down payment, which would be $200,000, and they're getting a fixed rate 30-year mortgage at a 3.25% interest rate. We're going to start by calculating their total cash outflow, which is essentially the total amount of money they're going to have to spend every month in order to own the home. Then we're going to talk about how some of that money actually comes back to the buyer in the form of increased equity in the home and the tax savings you can take advantage of if you itemize on your tax return as opposed to taking the standard deduction. So if you have any questions as you're watching this video, please feel free to call, text, or email me anytime. You can find all of my personal contact information in the description below. I'm happy to answer your questions and help in any way that I can. Before we get started, I wanted to mention I created a very simple worksheet to help walk you through the analysis. So if you want to run your own numbers, just let me know and I'd be happy to send you a copy. We're going to start by looking at the total monthly cash outflow. And this is essentially the principal, interest, taxes, and insurance, which is commonly referred to as PITI. And then I added one extra line item for maintenance. So first we're going to look at the total monthly mortgage payment, which includes the principal and interest. And on our hypothetical example, that would be $3,482 a month. If you want to run your own numbers on what your monthly mortgage payment would be, you can find a mortgage calculator on our website under the Buyer Services tab. You just put in the purchase price, down payment amount, and interest rate, and it'll let you know how much your monthly mortgage payment would be. For property taxes, on this example, I'm estimating $917 a month, and that is based on a 1.1% property tax rate, which is roughly what we see in Orange County, California. If you're thinking about buying a house in a different area or a different state, I recommend doing some research just to see what your property tax rate likely would be in that area. One other thing to add, if you're thinking about buying in California and you're looking at a newer home, I also recommend looking into and making sure it doesn't have a Mello-Roos tax, because that can add an extra property tax on top of what the 1.1% would be. For insurance, we're estimating $316 a month. And for this, I'm using the calculation that they use in the California Association of Realtors Housing Affordability Index. They estimate that homeowners insurance is 0.38% of the purchase price. And finally, the maintenance line I added is just simply $100, just if you wanted to hire a gardener to do kind of a basic mow and blow service and help with some of the landscaping. So in total, you can see that the total cash outflow on this home would be $4,815 a month. Next, we're going to go a little bit deeper on the monthly mortgage payment. And in our example, we're assuming you have a 30-year fixed rate mortgage as opposed to some type of interest-only mortgage or adjustable rate mortgage. So your mortgage payment on a 30-year fixed rate mortgage stays the same throughout the entire loan. And a portion of your mortgage payment every month goes towards paying the interest on the loan, which is money that goes out the door and you're never going to see it again. That's why we've got it written here in red. This is not what we like on our monthly mortgage payment. The second portion of your payment goes towards principal. I've got this written in green because principal is a very helpful portion of your payment. The principal is what goes towards paying down the total amount of debt you owe. So every time you make a principal contribution, you're essentially increasing your equity in the home by the same amount. And so to help explain this, I thought it would be helpful to go through a quick example. So our buyer here bought their home for $1 million and they used a 20% down payment, which was $200,000. So their equity on day one was $200,000. Let's say they've made every payment over the 30 years, and on the 30th year, they make their last payment, and now they own their home free and clear. On that day, their home miraculously was still worth exactly $1 million. This person has increased their equity in their home by $800,000 over the 30-year period without their home appreciating in value at all. And so how this happened was every time they made their mortgage payment, a portion of that payment went towards paying down the debt. So they borrowed $800,000 and they paid back the $800,000 plus interest. So essentially they've converted that $800,000 they borrowed into equity in their home. A lot of people describe this sort of like a forced savings account because every month when you pay your monthly mortgage payment, you're contributing a certain amount of that money into the equity that you have in your home. I also wanted to point out that these are the portions of the payment that go towards principal and interest during the first month of the mortgage. So the way it works on a 30-year fixed rate mortgage is the total monthly mortgage payment stays the same throughout the 30 years, but the portion that goes towards principal increases every month, and the portion that goes towards interest decreases every month. This is really great because every time you make a payment, you are essentially contributing more and more money to your equity. By the time you get to the end of the loan on your last payment, most of your payment will go towards principal and only a little bit will be going towards interest. You'll see that when we get done with all of our analysis, we'll actually be subtracting the principal contribution from our total cash outflow to help understand what the true cost of home ownership is. Next, we're going to talk about some of the tax deductions you can take advantage of if you own a home or are thinking about purchasing a home. And the tax rules we're going to talk about took effect in 2017 and apply to homes purchased after that date. If you purchased a home before that date, there's a chance some of the rules are slightly different, so I'll let you talk to your CPA or tax attorney to get advice on how these rules apply to you. So the first one is the property tax and state and local income tax deduction. And you can deduct up to $10,000 of combined taxes you pay for property tax or state and local income tax. In this example, our property tax alone is higher than $10,000, so we're going to max out that deduction here. Next is the mortgage interest deduction. You can deduct the interest on up to $750,000 of your mortgage. So if you borrow $750,000 or less, you can deduct the entire amount of interest you paid. And if you're borrowing more than $750,000, you're limited to the interest you pay on the first $750,000 of your mortgage. Since in our hypothetical example, the buyer borrowed $800,000, we were limited to $750,000. But that still added up to roughly $24,000 in interest payments. If you're thinking about buying a home and you want to know how much interest you would pay in the first year, you can use our mortgage calculator under our Buyer Services tab on our website. And if you have an existing loan, your lender will actually send you a statement each year that shows you exactly how much interest you paid on your mortgage. Now we're going to compare the total itemized tax deductions you could take if you purchased a home to the standard deduction you could take if you decided to continue renting. So our total itemized deductions on this purchase is $34,000. And we're going to compare that to the standard deduction if you're filing singly or if you're filing jointly. So the standard deduction for somebody filing on their own is $12,550 for 2021, and the total standard deduction for people filing jointly is $25,100. So what we've done is we've subtracted the standard deduction from our total itemized deduction. So you can see for the person filing singly, this would be a $21,600 difference in tax deductions, which is pretty huge. For people filing jointly, the difference between the standard deduction and the itemized deduction is only $8,900. So if you look at what their tax savings would be, assuming that this amount of income is being deducted from a 40% tax bracket, the person filing singly would save $8,580 on their taxes every year, and the people filing jointly would save $3,560. So we're going to take that number, turn it into a monthly savings, and subtract it from our total cash outflow every month. Okay, now that we've got all of our numbers ready, we can do the final calculation to see what the true cost of home ownership is. So we're going to start with our total cash outflow, which is $4,815 a month, and we're going to subtract our principal repayment in the first month of the mortgage, which is $1,315, to arrive at $3,500. Then we're going to take the tax savings we would get and subtract that as well. So for somebody filing singly, their monthly tax deduction would amount to $715. When you subtract that from the $3,500, you get the true cost of home ownership for somebody filing singly at $2,785 a month. So now if we look at people who are filing jointly, their monthly tax deduction would be $297 in savings, and so their true cost of home ownership would be $3,203 every month. Now, I did a little bit of analysis to see about how much it would cost you to rent an equivalent home to what you would get if you paid $1 million for a home in the Orange County area. I found that the rent on a home would be about $3,500 to $3,800 depending on the location. So you can see that your cash outflow every month would be higher than what it would cost you to rent the equivalent home. But by the time you're done with the principal repayment and the tax deductions, it's actually cheaper to purchase a home today than it is to rent an equivalent home. And to take it one step further, if you stay in the home long enough to pay your mortgage off, the cost savings between owning your home free and clear and paying the equivalent rent on that home are going to be huge. There are a lot of people who have retired in Southern California, and they probably would not be able to continue living here if they didn't purchase their home a long time ago and pay it off, because their fixed monthly income has remained relatively low compared to where housing prices have gone. So these people have been able to retire and stay near family and friends because they purchased their home a long time ago, whereas if they had not, they may have been forced to move out of state to a more affordable area. Before we wrap this video up, I just wanted to mention a few more things that you need to consider when you're doing this calculation. First is homeowners associations, or HOAs. In our example, this property was not located in an HOA, but if you buy a home that is, you'll have to add the monthly HOA dues to the total cash outflow portion of this calculation. The second factor is repairs. So obviously when you own a home, there is some additional maintenance and repairs that may need to be done that wouldn't be your expense if you were renting the home. So you need to consider those factors when you're doing your analysis. And the reason I didn't include it in our example is because there is an extremely wide range of what the repair costs could be. If you buy a newer home or a home that is in extremely good condition, your repair costs are likely going to be extremely low for a period of time. On the other hand, if you buy a home that requires a lot of work, you could have some pretty high repair costs in the first few years getting the home back up to good condition. So you need to do that analysis on your own on a case-by-case basis, depending on what type of home you're going to purchase. And if you are looking for a home in Southern California, that's one of the things we talk about heavily with the buyers we work with, is when we're showing them homes, we always point out things that could be a potential major expense for them, within the next few years. So if you have any questions on that, please feel free to call or email me anytime. I'm happy to walk you through what some of the major repairs and expenses could be on a property. And the last thing I wanted to mention is, in this analysis, we are also not taking into consideration the fact that rents historically have risen very steadily. On the other hand, if you purchase a home, you're locking in your monthly mortgage payment on that date as long as you don't refinance. So as time goes on, there's a chance that your monthly mortgage payment will stay the same while rents continue to rise, and then the total amount of savings you get by owning a home increase based on that difference. Thank you so much for watching. I'm Tim Hamilton with StellarQuest Real Estate, and I really hope you enjoyed watching this video. If you're thinking about buying or selling a home and you need some help, please give me a call or send me an email. If you're in Southern California, I can help you out, but if you're located somewhere else, I can refer you to a really great agent in your area. If you want to stay up to date on the housing market and other real estate related topics, please subscribe to our channel and like this video by hitting the thumbs up button below.